Right now, something is happening in the COMEX silver market that almost nobody is explaining correctly. The price is not crashing. That is what makes this so dangerous. Most investors look at silver at $29 or $30 an ounce and see stability. They see a metal that is down 10% from its high, but still trading in a range. Nothing dramatic, nothing urgent. That is the mainstream explanation, and it is wrong, because price is not the signal. The spread between paper claims and physical metal is the signal, and that spread is widening in silence. Here is the paradox. The system for delivering silver is cracking at the exact moment the price looks calm. Registered inventory on the COMEX has been falling for months. Open interest remains high. That means more paper claims chasing fewer real ounces. In any other market, that would trigger a violent repricing, but not here. Not yet. Why? Because the banks and hedge funds are not fighting the move. They are repositioning quietly, and what they are doing tells you everything about what comes next. I have watched markets for 40 years. When the plumbing cracks before the price moves, the price move, when it comes, is never small. By the end of this breakdown, you will understand three things that 99% of investors will miss. First, the exact mechanism of how COMEX silver works. Not the theory, but the actual plumbing. You will see where it is breaking and why that matters more than the daily price. Second, why banks and hedge funds are not buying the dip. They are doing something else entirely, and that something else tells you they expect a liquidity event, not just a silver rally. Third, the two numbers you must watch to know when the system tips from stressed to broken. Not opinions, not predictions, just data. If you value this kind of system-level analysis, the kind that sees cracks before they become collapses, because what I am about to show you is not being covered anywhere in the mainstream financial press, and that is exactly why you need to see it. Let me start with a definition that sounds basic, but is almost always misunderstood. The COMEX is not a physical silver exchange. It is a futures exchange. That means when you buy a silver futures contract, you are not buying silver. You are buying a promise to deliver silver at a future date. Most contracts never reach delivery. They're closed out, rolled forward, or cash settled. That is normal. That is how the system was designed. But here is where the mechanism gets fragile. Every futures contract has two types of inventory behind it. The first is called registered silver. This is metal that has been formally inspected, approved, and set aside specifically to satisfy delivery on futures contracts. Registered silver is the only inventory that matters for delivery. The second is called eligible silver. This is metal sitting in COMEX warehouses that meets purity requirements but has not been formally registered for delivery. It could be registered if someone requests it, but it is not pledged yet. Now here is the number that should stop you. As of recent reporting, registered silver on the COMEX has fallen to levels not seen in years. We are talking well below 50 million ounces. In some weeks, it drops below 40 million. Meanwhile, open interest, the total number of outstanding futures contracts, remains consistently above 100,000 contracts. Each contract represents 5,000 ounces. Do the math. 100,000 contracts represents 500 million paper ounces of silver. But registered inventory stands at less than 50 million physical ounces. That is a 10-to-1 paper-to-physical ratio, at minimum. In reality, because multiple contracts trade against the same registered inventory across different delivery months, the effective leverage is much higher. Now here is where this gets important. That 10-to-1 ratio is not a problem, as long as no one demands delivery. The system works on confidence. It works because most participants are speculators or hedgers who close their positions before the delivery period begins. They take cash, not metal. But what happens when someone does demand delivery? What happens when a large physical buyer, say an industrial user, a sovereign wealth fund, or even a coordinated group of investors, decides to take the metal? That is the puzzle the mainstream is not asking. Because if even 10% of open interest demanded delivery, registered inventory would be wiped out. The exchange would have to scramble to register eligible silver. And if eligible silver is also low, which it has been, then the exchange faces a choice: suspend delivery, change the rules, or allow a default. In 2020, during the COVID panic, the COMEX gold market came within hours of that scenario. The spread between futures and physical gold exploded to $70 an ounce, unheard of. The exchange had to introduce a new deliver gold contract to prevent collapse. That was gold. The deepest, most liquid metal market in the world. Silver is smaller, less liquid, more concentrated, and the cracks are already visible. Most people are asking, is silver going up or down? That is the wrong question. The right question is the system still solvent when someone tests it? Stay with me, because in Chapter 2, I will walk you through the exact step-by-step mechanism of how this crack spreads from silver into everything else. Now let me show you exactly how this works. Write this down because the sequence matters more than any price forecast. Step 1. The contract is a promise. When a bank or a hedge fund sells a silver futures contract, they are making a legally binding commitment to deliver 5,000 ounces of physical silver on a specific date. Most of the time, they have no intention of delivering. They intend to buy back the contract before delivery and take a profit or loss in cash. That is fine. That is the design. But the contract itself does not know intention. It only knows obligation. Step 2. The shorts rely on infinite liquidity. The entire short-selling model on COMEX assumes that if someone demands delivery, the short can go into the open market, buy physical silver, and deliver it. That assumption works when physical markets are deep and liquid. It fails when physical silver becomes scarce or when everyone tries to buy at the same time. Step 3. Registered inventory is the first line of defense. When a long holder demands delivery, the exchange assigns that demand to a short. The short must either produce a warehouse receipt for registered silver or go buy it. If registered inventory is plentiful, no problem. If registered inventory is low, the short must compete with every other short assigned for delivery that month. Step 4. Low registered inventory forces a scramble. This is the mechanical pivot point. As registered silver falls below a critical threshold, say 30 million ounces, the probability of a delivery scramble rises non-linearly, because now even a small increase in delivery requests eats a large percentage of available metal. And when shorts realize they cannot cover, they do not wait. They start buying back contracts preemptively. That pushes futures prices up. Step 5. The futures price diverges from the physical price. This is the hidden signal. In a normal market, COMEX futures and physical silver trade within a few cents. As the delivery date approaches, the futures price should converge to physical. But when registered inventory is low, the opposite happens. Futures trade above physical. That is called backwardation, and backwardation in COMEX silver is rare. When it appears, it means the paper market is more desperate for metal than the physical market. Step 6. Margin calls trigger forced selling elsewhere. Now here is where the crack leaves silver and enters the rest of the financial system. The banks and hedge funds short silver are not just short silver. They are leveraged across multiple positions. They own gold, they own bonds, they own equity index futures. They finance these positions with borrowed money. When silver futures spike, or when volatility rises, their prime brokers demand more collateral. To meet those margin calls, they do not sell silver. They sell whatever is liquid. They sell gold. They sell treasury futures. They sell S&P 500 ETFs. That is the transmission mechanism. A crack in silver becomes a sale in equities. Not because the economy changed, because the plumbing cracked. Step 7. The margin spiral accelerates. Once forced selling begins, other leverage players see falling asset prices. Their margin requirements also rise. They sell more. The selling feeds on itself. This is not a theory. This is exactly what happened during the 2008 gold backwardation event. Gold spiked in futures, then banks sold equities to raise cash, and the stock market dropped even as gold remained strong. Step 8. The exchange changes the rules. If the spiral continues, the COMEX faces a choice: They can raise margin requirements for silver futures, which accelerates forced selling. They can expand the list of deliverable brands or warehouses, which is a tacit admission that registered inventory is insufficient. Or they can do what they did in 2020, introduce a new contract with different delivery terms, effectively admitting the old contract is broken. Every one of those outcomes is a loss of confidence. And in a fractional reserve metal system, confidence is the only thing standing between order and collapse. Let me be precise about what I am not saying. I am not saying the COMEX will fail tomorrow. I am not saying silver will go to $100. I am saying the mechanism now exists for a delivery squeeze that forces contagion into other markets. And most investors are looking at the wrong indicators entirely. That brings us to Chapter 3, where I will show you exactly why the mainstream reading of this situation is not just incomplete, it is dangerously misleading. The mainstream financial press has told you 3 things about silver. Each one is true. Each one is also dangerously incomplete. Myth 1. Silver's a volatile industrial metal, and this is just another down move. That is true, but incomplete. Yes, silver has industrial demand. Yes, it is more volatile than gold, but the current anomaly is not in the price trend. It is in the structure of the futures curve and the inventory drawdown. Price volatility is normal. A falling ratio of registered inventory to open interest is not normal. It is a mechanical warning. The headline is not the story. The story is the plumbing. Myth 2. The COMEX has never failed to deliver, so it never will. This is the most dangerous myth of all. The COMEX has never failed to deliver, until it does. Every financial system works perfectly right up to the moment it does not. The London gold fix worked for decades. Then, in 2014, banks were caught manipulating it. The repo market worked for decades. Then, in September 2019, overnight rates spiked to 10% because no one had collateral. History does not warn you with a siren. It warns you with falling registered inventory and rising open interest. Those numbers are not opinions. They are data. Myth 3. This is just a silver bug conspiracy theory. I understand why people say this. The silver market has attracted more than its share of true believers predicting imminent collapse. That history makes serious analysts dismiss any warning as noise, but dismissing a structural anomaly because you dislike the messengers is not analysis. It is bias. Let me separate the signal from the noise. The signal is not a price target. The signal is the ratio. Registered inventory divided by open interest multiplied by 5,000 ounces. That number tells you how many contracts could be delivered with existing metal. When that number falls below 1, the system is technically insolvent. It cannot deliver on all outstanding claims. We are not below 1 yet, but we are closer than at any time since 2020. And in 2020, the Federal Reserve had just cut rates to 0 and launched unlimited QE. Today, rates are high, bank reserves are lower, and the Fed is not coming to save the silver market. What the smart money sees. Here's what the large players understand that retail misses. They do not care if silver goes to $35 or $25. They care about optionality. They care about holding an asset that is not someone else's liability when the paper system cracks. That is why you are seeing quiet accumulation of physical metal by family offices, sovereign funds, and even some central banks. Not because they predict a price spike, because they are insuring against a delivery failure. Price is moving for one reason. Value is changing for another. Now, zoom out. Because this moment in silver is not happening in isolation. It is the latest chapter in a 50-year pattern of paper metal systems being tested. In Chapter 4, I will show you the historical framework that tells you exactly how this ends. Now, let me show you why this moment feels familiar to anyone who has watched markets through multiple cycles. In 40 years of watching markets, I have learned that financial systems do not break because of one event. They break because the same structural vulnerabilities appear again and again, and each time market participants convince themselves that this time is different. It is never different. 1979 to 1980, the Hunt brothers and the physical squeeze. The Hunts tried to corner the silver market. They bought physical metal and futures. The COMEX changed the rules. They raised margin requirements. They limited position sizes. The price went from $50 to $10 in 4 days. The mainstream lesson was, don't fight the exchange. The deeper lesson was different. The hunt succeeded in exposing how few real ounces backed the paper market. At the peak, COMEX silver open interest represented nearly a year of global mine production. That was not possible. The system was always fragile. It just took someone large enough to test it. 2008, gold backwardation and the paper crack. In late 2008, after Lehman failed, something strange happened in gold. Normally, gold futures trade above physical gold, contango. In October 2008, the opposite happened. Futures traded below physical. Investors were willing to pay a premium for metal they could take delivery of immediately. That was gold backwardation, and it was terrifying to people who understood it. Why? Because it meant the paper gold market was no longer trusted. Banks and hedge funds were so worried about counterparty risk that they would pay extra to hold physical metal instead of a futures contract. The spread lasted for weeks. Then the Fed flooded the system with liquidity and confidence returned. But here is what they do not tell you. During those same weeks, equities crashed. Not because of earnings, because leveraged players sold whatever they could to raise cash. Gold backwardation did not cause the stock crash, but it was a canary. And most investors did not even see the canary. 2020. COMEX gold delivery crisis. This is the closest analog to today. In March 2020, as COVID lockdowns began, the COMEX gold futures contract for April delivery traded nearly $70 above physical gold. That spread should be impossible in an efficient market. What happened? The usual arbitrageurs, banks that would buy physical, sell futures, and lock in a profit, could not operate. Refineries were closed, shipping was disrupted, planes were grounded, you could not get metal from London to New York. The COMEX solved it by creating a new contract that allowed delivery of 100-ounce bars instead of 400-ounce bars. That was smart. It was also an admission that the original contract was broken. Now here is where the story changes. In 2020, the Federal Reserve cut rates to 0 and announced unlimited asset purchases within days. Liquidity flooded the system. Every market was backstopped. Today is different. Rates are at multi-decade highs. The Fed is shrinking its balance sheet. Bank reserves are lower. There is no cavalry coming for silver. The structural framework. Here is the pattern I want you to see. Phase 1. Low interest rates and abundant liquidity encourage leverage. Banks short metal because it is a low volatility carry trade. Phase 2. A shock occurs. Inflation, war, supply disruption, or in this case, falling mine supply and rising industrial demand. Phase 3. Registered inventory falls. Open interest stays high. The ratio becomes dangerous. Phase 4. A large physical buyer demands delivery. The paper shorts cannot cover. Margins spike. Phase 5. Forced selling spreads to other assets. The metal crack becomes a liquidity event. Phase 6. The exchange changes the rules. Confidence is lost. The system resets at a higher price level. We are between Phase 3 and Phase 4 right now. The only question is whether a large buyer tests the system before inventory rebuilds. And if they do, the transmission into equities, bonds, and other risk assets will be faster than anyone expects. That brings me to Chapter 5, where I will give you the exact indicators to watch. Not opinions, not predictions, just data points that will tell you when Phase 4 begins. If you take nothing else from this breakdown, watch these 4 numbers. They will tell you everything the headlines will not. 1. COMEX registered silver inventory. This is the most important number. Weekly data is published by the CME Group. When registered inventory falls below 30 million ounces, the system enters the danger zone. Below 20 million ounces, a delivery scramble becomes almost certain. Watch the rate of change, not just the level. A drawdown of 1 million ounces per week is manageable. 3 million per week is a warning. 2. The spread between front-month futures and physical silver. Specifically, watch for backwardation. When the front-month contract trades above the second-month contract by more than 20 cents, physical buyers are willing to pay a premium for immediate delivery. That is the market telling you the paper system is straining. If that spread widens to 50 cents or more, The 2020 repeating in silver. 3. LBMA silver lease rates. The London Bullion Market Association publishes lease rates for silver. These are the rates at which metal owners lend physical silver to banks. Normally, lease rates are near zero. When they spike above 1%, it means physical metal is scarce. When they spike above 2%, it means banks cannot find metal to borrow. That is the smart money signal. 4. The gold-silver ratio. This ratio normally trades between 50 and 80. When it breaks above 90 while silver registered inventory is falling, you have a divergence. Gold is rising relative to silver, but silver is becoming physically scarce. That combination has historically preceded delivery squeezes. Watch for a ratio above 92. Those 4 indicators. No predictions, no hype, just data. If registered inventory stabilizes and rebuilds, the system heals. If it keeps falling, the mechanism I have described will trigger. Not because of a conspiracy, because of math. Let me close with something uncomfortable. Most investors will not see this crack until it is already spreading. They are trained to look at price. They are trained to read headlines. They are not trained to watch inventory data, futures curves, and lease rates. That is not their fault, but it is their risk. The COMEX silver system is not broken yet. I want to be clear about that. Registered inventory is low, but it is not zero. The exchange has tools to manage a crisis. The banks are not idiots. But here is what I have learned in 4 decades of watching markets. The cracks always appear before the collapse. And when everyone says the system is fine, when the price is calm and the headlines are boring, that is exactly when the smart money is repositioning. You do not need to predict the future. You just need to watch the mechanism. If registered inventory falls below 30 million ounces, you will know. If backwardation appears, you will know. If lease rates spike, you will know. And on that day, you will not be guessing. You will be watching the same data points the banks are watching. The system is cracking in silence, but it is cracking. Now you know where to look.